Good morning and welcome to First Wave Cloud Technologies, our third quarter investor update. I'm John Grant, Executive Chairman of First Wave, and joining me today is our Chief Executive Officer, Neil Pollock, and Chief Financial Officer, Ian Bartram. Today's update is on First Wave's unaudited Q3 results. We've lodged the presentation on the ASX portal, and it's been emailed to the address that those of you who have registered provided. You'll also see in the pack that there's an appendix which has some slides that relate to the technology and relate to other aspects of this business. And if you've got any questions about any of that pack, ask them either on this call or email us subsequently. And following the presentation, we will open the lines for Q&A. Before we get on to the Q3 update, as you're likely aware, First Wave entered a trading halt on Wednesday to undertake a capital raise. The placement component of $6 million to institutional and sophisticated investors was oversubscribed and closed late Wednesday. Placement price was 9 cents, which represented a discount to the 5-day VWAP to the 27th of April of 8.3%, or a discount of 14.3% to the closing price on the 27th. The 66.7 million shares that will be issued as a result represent 10% of issued capital. We've also announced an SPP capped at 2.5 million, which will open on the 7th of May and close on the 28th of May. My and the company's sincere thanks go to those shareholders who have supported the placement or, through the SPP, will support this raise. The rationale for the raise is twofold. Firstly, together with cash on hand, it will provide working capital to offset the change in payment terms with Telstra flagged previously from annual in advance to monthly in arrears. And secondly, to continue the initiatives we have in place to support existing partners take our products to market, position ourselves to capitalise quickly on the return after COVID-19 of our UK, European and Middle Eastern markets. And finally, and we'll discuss this in more detail in a moment, to take control of an evolving relationship with Cisco to improve the outcomes we're currently getting. I'll be very happy to take your questions on anything related to the raise at the end. Let's now move to the Q3 update and the headlines, which I'll run through before Neil expands on each of these and summarises. Firstly, international revenues, which we've always said is the proof statement of the value of this business, continue to grow strongly. The most recent data point is our third quarter growth over Q2, which was 96%, but this has largely been the trend throughout the year. Secondly, we continue to get more partners committed to sell our portfolio of offerings. At the end of Q3, we had 49 billing partners, up from 46 at the end of Q2. And as Neil will explain, average revenues per partner are accelerating. Thirdly, we're delivering more cybersecurity services from our platform for our partners to sell. 3 new services will deliver new revenue in Q4. Costs are down in Q3 and projected to be in the order of $2 million down on FY20 by year end. And we see the potential for further reductions into FY22, offset, of course, as I've indicated, by investments we'll make following the raise. And finally, the Cisco agreement, which has always held promise, but frustratingly for both parties and also for shareholders, has failed yet to deliver to expectations, is under review. We're in discussions to evolve that relationship to a form that provides greater opportunity for First Wave to directly engage with Cisco customers and reduce our investment. As Neil will explain, when these discussions finalised compared to the current situation, the net impact will be positive to First Wave. So in summary, we're very pleased that in spite of the continuing market uncertainty, all the key metrics are heading in the right direction. International revenues are up, number of billing partners is up, average billing per partner is up, number of services available is up, expenses are down, and our relationship with Cisco is potentially heading to a better place. Let me turn over to Neil to elaborate further.
Thanks very much, John, and good morning, everyone, and thank you for your time. I'm now on slide 4 of the presentation. Our international annualised recurring revenue is growing strongly. The graph on this slide shows the quarter-on-quarter growth during FY21. And in summary, Q1 revenue was up 95% over the June 2020 exit. Q2 was softer, up only 16% over Q1 due to contract timings, but it was the first time the company broke through $1 million in international annualised recurring revenue. And in Q3, growth returned to 96% quarter on quarter to almost $2 million. Now, we all know that domestic revenue, which is effectively Telstra at the moment, is flat, but we continue to explore new offers to take to market to return domestic revenue to growth with Telstra, as well as exploring other partner opportunities in Australia outside Telstra. Based on our view of the current opportunities, we have a reasonable expectation that what we're currently experiencing will continue in Q4 and into FY22. Slide 5 shows that we've increased the number of both our level 1 and billing partners. We exited Q3 with 49 billing partners, up from 46 in Q2 and up from 26 at the start of the financial year. Our level 1 billing partners grew to 9, up from 7 in Q2 and 5 at the start of the financial year, opening additional markets for us. Importantly, the average billing per international billing partner grew strongly, up 84% quarter on quarter. But my note here is that this is an increase on a small number. It is a point in time measure, so it's going to fluctuate, but what it does show is an improving trend. So our focus for Q4 is continuing to bring on new partners while harvesting our existing partner base to grow our international run rate revenue. On slide 6, we're also continuing to bring on more services for our partners to sell. Our product portfolio is continuing to expand. Acknowledging the situation in India, both our partners and our team members are facing at the moment, which is a torrid time with COVID-19. Our thoughts are with them at this time, but in spite of this, we continue to work with our partner, to launch a new multi-tenant next generation firewall service based on Palo Alto technology, which has been integrated onto the Cloud Content Security Platform, the CCSP. We're also in the final stages of negotiation to launch a new offering for Advanced Detection and Response, ADR, which we're calling First Cloud Cybersession, a joint development with our partner Shell Global out of the Middle East. In its first release, Cybersession will build on our current threat prevention capabilities for email. But by the end of the calendar year, we plan to have it also apply to our web, firewall, and endpoint protection services. This is a first for the SMB market, and it's aligned to our mission of democratizing enterprise-grade cybersecurity as a service for that segment of the market. So not only will it enhance our offering in new opportunities, but we will take it to our existing partners for our current customers as an upgrade to their existing service. Thirdly, in Q2, we announced the new exclusive web security service with Simplified Systems in the UK. It uses an opt-out deployment model where SMB end user customers automatically get the service as part of their broadband subscription, and they have to opt out to turn it off or not be billed for it. This is a new way of taking our products to market and is more sticky, and adoption is much easier. As mentioned before, we've opened new markets in Africa on the back of this launch, and initial sales contributed strongly to the Q3 results. This is expected to continue into Q4 and beyond, when we will also take it to markets in all other regions. Moving on to slide 7 on costs. Reflecting our continued focus on cost management, our cash on hand at the end of Q3 was $6.3 million. Our expenses at year end are forecast to be down $2 million, circa 10% year on year. And we plan to take out additional cost in the first half of FY22 to include reduced corporate costs and reduced employee expenses. We have also increased our investment in sales and marketing as we had intended, and we've sustained investment in product and development, enabling us to release additional services, as I've just mentioned. As John mentioned, our relationship with Cisco is evolving, and slide 8 details how that's going. As a refresher, or for those of you who are new to First Wave, we signed an agreement with Cisco in 2018 for an initial term of 5 years, with an option to renew for 2 years thereafter. Under this agreement, the responsibilities are very clear. We're responsible for software engineering and development, and Cisco is responsible for BD, sales, marketing, and therefore revenue turn on. Now, both parties have expressed frustration at the low rate of growth of revenue. Even though there are presently 29 contracted level 2 partners, 14 of whom are billing, the monthly recurring revenue is frustratingly low. So discussions are underway to evolve this relationship from the current agreement and its obligations to a form that provides greater control of both revenue and costs through us engaging directly with Cisco customers and partners and their account teams. and significantly reducing costs associated with product development. Now, should discussions conclude in line with the current indications, there's only upside for First Wave, and it's our view that the net impact will be a significantly improved situation. So in summary, we're expecting continued growth, strong growth in our international annualized recurring revenue. We're well positioned for the post-COVID-19 recovery, and we will invest in ramping up momentum in the UK, Europe, and North America as businesses emerge in those markets from COVID-19. The global rollout of Web Protect DNS is expected to continue to drive revenue growth in Q4 from existing and new customers. Our first cloud cyber advanced detection and response offering is expected to deliver first revenues in Q4 as well. And our multi-tenant PAN next generation firewall to be launched with we in India is also expected to deliver first revenues in Q4. And as I just flagged, there's a potential change in the Cisco relationship to improve the current situation. Okay, we will now open the lines to Q&A. Ruth, let me start. Are there any questions for us, please?
Yes, we've got one question from Mark. He's asked, months of January and February saw good growth in international annual recurring revenue. The growth for the month of March was not as strong. Can you please comment on the month of March in relation to IARR?
Sure, John, do you want me to go with that? Yep. So look, great question. Yeah, and you're right. January and February were strong months. March less so. Overall, the quarter still delivered 97%, 96% quarter-on-quarter growth, and this is our business at the moment. Our business and contracts are lumpy, and so contracts that could have been signed in March may be signed in April. And so one of the reasons that we get this lumpiness is because our scale at the moment is such that a 4-day difference in signing a contract from one month to another can make a fundamental difference to the perception in the market. Whereas from a financial perspective internally, a 30,000 contract or a $360,000 annualized contract that falls in March or in April from a revenue turn on perspective is very little different, but from a perception perspective, whilst we're still building scale in the business, it has more of an impact on the way we talk about the revenue in the month. John, did you want to add anything to that?
Yeah, I think it's a really important question. And let me just take you back a little bit in history. So if we go back to our second quarter update, we said at that time that there are a number of variables in play, and I won't run through those, but a number of variables in play which we were watching, but which were going to play into our sort of forecasting and outlook. And in fact, that mapped out when we updated our shareholders in February. It was clear to us then that because of these factors, predominantly, frankly, COVID affecting our European, UK and Middle East markets, where we'd put a lot of investment in and we were at the point of generating the revenue as a result of that, that had been put into hold. We made a decision when we spoke to shareholders then that we would actually report monthly because we were not able to report against our plan. What our business does is, as Neil just described it, it's lumpy, right? So contracts come in one month or the next month, but they come. And what I believe is that in going to monthly reporting, it may have been the right thing to do at the time. And I'm very, I'm a very transparent person. I like our shareholders to know everything that's going on. There is no advantage in taking our shareholders on the roller coaster of month to month. That's not the way the business rolls. The business rolls much better on a quarterly basis where these sorts of things get smoothed out. So we will be reporting quarterly from now on. We won't be going back to monthly for that very reason. Your assessment about the month of March, as Neil said, is absolutely right. But that plays into Q4. So we'll report quarterly from here on out and not take you through the ups and downs of this business on a month-to-month basis. Thanks, Neil. Thank you, Mark.
At this stage, there's no further questions.
Okay, then I think what we'll do is open the lines. Does anybody have any questions? If you can indicate any questions via either raising your hand or just coming off mute, that would be great. Okay. Ruth, nothing more coming through the
No, there's no
chat?
further questions.
All right. Look, thank you very much for your time this morning. Thank you for your attention and thank you for your continued support. Sorry, Chris, you've just raised your hand. Yes, do you have a question? Okay, I can't hear Chris. Ruth, can we unmute Chris? Chris Gorman?
Excellent. Thanks, Neil, very much. The
Sure.
Cisco relationship is something that all of us have been very focused on for a long time. And the way I'm hearing it is that you've not been in control of the sales process. They have been, and now you are taking a larger hand in the sales process. That's if my understanding is correct, that's a fairly wide-reaching statement, and I'm not quite sure how you're likely to be able to achieve that, and what the likely implications are. You've said that it's very positive implications, but are you able to quantify and put some more structure around this issue, please, Neil?
Yes, I can, Chris. It's a great question, actually. So thank you. The situation, you're absolutely right. Under the agreement that we signed back in July 2018, very clearly the responsibilities were we were to do product development and engineering. And as I've said earlier in the presentation, Cisco's responsibilities were around, or are around, business development, sales, marketing, and therefore revenue turn on. But in discussions that we've had with them, and I don't want people to get the impression that nothing's been done, because it has. As I also mentioned, that might not have sunk home, there are currently 29 signed partners or customers of Cisco under their level 2 partners of Cisco. 14 of them are already billing. That is, they have live billable traffic flowing over the Cisco version of CCSP, which is called the Cisco Security Management Platform, CSMP. You would have heard us talk about that previously. So it's not as if there's been no progress. It's just that we're frustrated because the scale of that, given Cisco's scale, given the effort that's been made, and given their teams across the world, we expected it, and so did they, to be much more advanced than it is now. So when I say we're going to take more control, what they've done in the discussions that we're having, without giving away any of the confidentiality that we're under, the discussions that they're having is, listen, you guys are clearly getting traction and growth out of CCSP. You're out there in the market selling it through partners in the same way that we're trying to sell it through our account teams. Look, let's have a discussion about how we might evolve the agreement to something that's better and benefits both you and us, so that you start to get the revenue and our customers start to get the benefits of the CCSP or the CSMP. So it's not as if we're going to cut them off and not deal with them. So I was very, very, at the moment, the discussions are around how do we work better with the Cisco account teams and the existing, firstly, Chris, the existing 29 partners that are already signed, and get them generating incremental revenue the same way that we've been able to do it. So in terms of the approach that we take, we already have just under a dozen red badged people in First Wave. These are people that have a Cisco ID, they have a Cisco email address, and they've been sitting on the sales calls with the Cisco account teams anyway. So we already have a relationship with both the account teams and the partners. What we're saying is, you know what, we're getting success with CCSP. Why don't you let us work more closely with you and more directly with your customers and partners to accelerate the growth in the revenue? I hope that answers the question.
Yes.
There are reasons for it, which I can talk to you offline about in terms of the reason that they've struggled to accelerate the growth of the revenue, but I can talk to you separately about that.
Very helpful. Thank you, Neil.
Thanks, Chris. Thanks for the question. I think Guy Mitchell also had, I saw a hand come up from Guy Mitchell. Guy, did you have a, was it Guy who?
Yes, Guy, you should be able to speak.
Right. Thanks very much, Ruth.
Hi, Guy.
Sorry, I missed the first minute of the call. I was just wondering if we could go back to slide 1, just to have a question around the offer to retail clients, if that's possible, or retail shareholders.
You're talking about the capital raise,
Yes,
Guy?
it's the slide that John was talking to.
Yeah, sure. John, and I'll also, if you're okay, if you want to take that as well.
Yep, sure. Go ahead, Guy.
I was just interested in the logic behind you've gone out to placement to institutional and sophisticated investors. One, how do you go about identifying your sophisticated investors as opposed to institutional investors?
Yeah, well, we don't identify them. The brokers who deal with us identify them. So the real world situation is that Morgans, who are acting as lead manager for the bid, work with number one, institutions directly, but number two, they work with brokers who bring on board their sophisticated clients, and they ask the brokers what allocation do they want for their sophisticated clients in the raise, and that comes into the book. And then allocations are based on all of the submissions that come into the book. So sophisticated investors come in as part of the broking community directly from their brokers.
Right. Okay. So you're very much reliant on in this case Morgans to identify sophisticated investors.
Yeah, Morgans, and let's just say, we've got good support through Bell Potter, through one of their lead brokers, and that broker has his clients, and those of whom of his clients are sophisticated investors. He asks them, what quantity are you interested in this raise? If so, what do you want us to go in from an allocation point of view? He then bundles all those together and he goes back to Morgans and says, this is what my sophisticated clients would like to be allocated in the raise.
Okay. And then if we go on to the retail shareholders, which has been capped at 2.5 mil, that's basically about 31% of the total funds being raised. Why you go through a process of limiting retail shareholders to less than, say, 50% of the placement, an SPP?
So the 31% you're talking about is 2.5 on 6. Is that what you're saying?
No, it's 2.5 on 8.5.
Yeah. The why is number one. So let me go back. When we were deciding the cap for the SPP, and when we looked at all of the shareholders right across the register down to unmarketable parcels, what we're concerned about is dilution of shareholders through the SPP process. So when we looked at that, what it showed us was that if a shareholder takes up to $30,000 as part of the SPP, which is the limit on the SPP per shareholder, if they take up to $30,000, in fact, their position will be improved in terms of their percentage of the overall company. So it's a balancing thing, Guy. You have to decide how much money you need, and then you have to decide how you're going to allocate that across institutions and retail. And then within retail, we did the check that said, okay, if the retail shareholders do take up their allocation or their available allocation, all of those above unmarketable parcels will actually improve their position in the company. So that's the rationale that applied. And at $2.5 million, we were able to guarantee that could happen.
Okay.
Now, clearly, if retail shareholders don't undertake to participate in the SPP, then their percentage of the shares in market or shares on issue will actually reduce, but the percentages are very small.
Right. Okay. I was just curious to understand the logic behind. There's been some talk in the press recently about retail shareholders being sort of let's call it disadvantaged compared to institutional and sophisticated investors. And it just struck me as perhaps this is another example of that. And I was just wanting to understand your logic behind limiting it to 2.5 in a total of 8.5 mil. So thanks for that, John.
That scenario that you've just profiled about dilution is absolutely correct. And in a lot of SPPs, that's exactly what happens. But we did the numbers on this one. The board, and just to repeat, the board was, because of what this company's been through previously and what its shareholders have been through previously, and there's no doubt that in previous raises, the SPP has had that impact. We were very mindful of making sure that we did absolutely the best job we could in terms of preventing, presuming people participated, preventing dilution. And I think on balance, we've come out very well. So, and happy to share that, so more detail on that information if it's helpful.
Thanks very much, John.
We have one more question that's come through on the chat line from Mark. If First Wave is successful to be allowed to engage directly with end customers, what will First Wave do differently to what's currently being done to successfully drive stronger take-up?
That's another good question. So let me take that. The difference is, I think the way to answer that question is to explain the way it works at the moment, Mark. So Cisco account teams are incented to sell Cisco. So anything that has a light blue logo on it with, you know, the Golden Gate Bridge is what they sell. So their DNA is to make a sale, move on to the next sale. We know from our experience that once you've sold the capability of CCSP or SMP, you have to do follow-up. You have to stay connected with the partner. You have to engage them in, you have to assist them with sales enablement, assist them with their operational support, assist them with marketing support, go and do sales calls with them into their own partners and things like that. That's not the Cisco sales model. So what we will do differently is we have a vested interest in making sure that the effort that's gone into signing 29 partners is turned into revenue. So the other side of that has been that because we are not blue badged Cisco, we can't simply pick up the phone to the partner or the customer without, outside of the Cisco framework and engage with them to say, hey, why aren't you selling more SMP plus email, SMP plus email plus AMP? So what happens is what we're in discussions about is, and as I just want to be really clear here, this is still under discussion, so nothing has been finalised. But what we want to be able to do is do that. We want to be able to do what we do with our CCSP partners. And in fact, Cisco have told us that that's what they've seen us being successful at. We want to be able to pick up the phone, connect the account team and the partner and say, hey, we want to talk to you about how we might drive a marketing campaign to get more of your end users and end customers onto SMP. That's the difference. The difference is being able to be on the front foot rather than quote unquote waiting for the Cisco account team to take the initiative, because they're not incented to do it, whereas we are. I hope that answers that question.
Neil, can I just add to that? Because I think we need to be completely as open as we can with shareholders. Neil put the caveat into his answer then that these discussions are still occurring and yet to resolve. But Cisco's commitment, the people we're working with, which is from their product business, what they realise is they've got 14 of their customers actually billing through this Cisco security management platform, which is our platform. So they've got a responsibility to them to deliver continuity. So they have an issue they need to deal with, and I think that lends itself to an outcome which is as Neil has described. However, because the discussions haven't been finalised, it may well be a different outcome, a lesser outcome. We may not be able to engage directly, whatever. Just let's go through those sorts of scenarios. Let me just say that whatever happens, it will be better for First Wave and for shareholders in the current situation. So on one end of the spectrum, should we not continue at all, we will take a lot of cost out of our business. And in the 2.5 years that we've been engaged around this contract, in the 2.5 years we've been engaged around in this contract, we've come a long way outside of our Cisco it was we were a one pony, what they call a one-trick pony. When the Cisco agreement was put in place. Since then, we're no longer that. CCSP has been now taken globally, all the things we've reported to you about. So we know we can do this stuff, and Cisco knows we can do this stuff. So whatever happens, we'll be in a better position from a shareholder point of view, and that's what's critical to us. There's no doubt that there's disappointment. Certainly, we're disappointed that we haven't been able to fulfil it as per the original objective, but things were not in our control. And when you don't have things in control, you've got to somehow move to a position of control, which is exactly what Neil's described. But it'll be better no matter what happens. And however, taking the optimistic view, we've got 29 customers who have already said that the security management platform is where they want to go. And if you think about it, we can offer those customers a better scenario than Cisco can because we've got a broader range of products. So it remains to be seen. Disappointed that it didn't end in a better, didn't conclude or didn't head in a different direction, in the direction we would have hoped. But nonetheless, whatever direction it ends up in will be better for this company and better for shareholders. I hope that helps as well.
Thanks, John. At this stage, there's no further questions. If anybody does have any questions, please either raise your hand or enter them into chat.
Okay. Look, thank you once again. John, would you like to close off? Or are you happy for me to?
Look, thank you, Neil. I would. Look, I'd just like to thank the shareholders who continue to support this company. Whether or not you participate in this raise is a moot point, but you are still supporters of this company through your shareholding. We absolutely believe that we're now really demonstrating the power of the model that we've put in place. We're working very hard, I can tell you that, as a business to get the outcomes that we believe are possible. And that's right across from the board, right through to everyone in the business. And we're all focused on that as the outcome. The capital raise will give us a lot more runway than we had. And that's a very good thing because we're going to prove, or not, frankly, but our belief is we will prove that the business model we put in place and the opportunity we've described to you on many occasions is there and it's real and we can capitalise on it and capture it. So now we're going to be heads down and bum up, frankly, as we have been. I guess is probably the reality, but if we're taking out of this business the imperative around funding all the time is a very big deal for the people inside the business because we've got so much work to do. So I just thank you on behalf of the board and on behalf of the company for continuing to support First Wave. We think that your money is well placed and our job now and our opportunity is to prove that point to you. That's fine from me. Thank you, Neil.
Thank you very much. Thank you for your time and very good morning.